A very good morning, dear students. So, I Chickpat Madam welcome you all to this business studies class. And in today's class, I am going to discuss techniques of managerial control. So, in previous classes, we have discussed about the important function of management, that is controlling, its meaning, definition, importance, right? Then we also discussed in detail about controlling process, right? So the controlling is most essential function of any organization. So without controlling, that is execution is becomes very much impossible, right? So then when this controlling function is very much essential, then how this function is adopted, how it is managed, how it is adopted in the organization, that we are going to discuss today through studying the techniques of managerial control. Okay, how the controlling is done, what are the techniques of controlling the subordinates in the organization, that we are studying today. So here there are two techniques, traditional technique and modern techniques, right? So traditional technique means that these are the techniques used from the long time, okay, from so many years back from the companies, right? So there are four types of traditional techniques, that is, and still today these techniques are also followed. They are not means outdated or obsoleted, okay, they are in practice till today. They are used from the long time, that's why they are called as a traditional techniques. And modern techniques are adopted in the recent years, that's why they are modern techniques. So under traditional techniques, the first one is personal observation, second one is statistical reports, collecting the data, statistical reports, third one is break-even analysis, then fourth one is budgetary control. So all these things we'll study in detail in this video. And in the modern techniques we have, that is around six techniques. First one is return on investment, second one is ratio analysis, and third one is responsibility accounting, and fourth one is management accounting, fifth one is PERT and CPM, and sixth one is management information system. So generally these techniques, they will ask for 4 marks, right? 4 marks. Traditional techniques are modern techniques, and they will tell you to explain any 4 items, okay? Then this PERT and CPM, generally it will be asked for 1 mark for expansion. Expand, P-E-R-T, PERT, okay, that I will going to that is explain you while explaining all these individually. Then CPM, what is the expansion of PERT and what is the expansion of CPM. So generally these are the questions which they will ask for 1 mark, right? So these techniques, you remember, are any 2 mark question also they may ask. Write any 2 traditional techniques, just writing the names, or they may ask write any 2 modern techniques of managerial control. So such type of questions will come for the exam, right? And now we will study in detail the traditional techniques of managerial control. And what is the first one, right? Personal, okay, traditional techniques. Under that, the first one we are discussing is personal observation. Then what do you mean by personal observation? So how the controlling is done? It is the most traditional method of controlling, very old one, okay, from the beginning this method is adopted until today it is in practice. It is the most traditional method, and here the thing that is, information is collected by observing person, subordinate, personally, supervisors, through supervisors. The personal observation is done through the supervisors. Supervisors are appointed to look after the works of the each and every individual subordinates, and the information collected by these supervisors will be first hand information, that is true information. Whatever happens, then it is as it is, the information will be collected by the supervisors. Okay, and it creates a psychological pressure on the subordinates to perform well, because they know that somebody is observing them. Okay, somebody is looking after them, somebody is, that is, checking their work continuously, regularly. It means there is no chance of wasting time, right? There is no chance of doing any wrong work. So, and automatically it brings psychological effect, it brings psychological pressure on the employees to perform well, right? Because somebody is seeing you, somebody is observing you, and they are continuously seeing that how you are doing. If somebody is seeing your work, then automatically you prefers to do it best. Yes, automatically the work will be improved. It creates psychological pressure to perform well. And one thing is, it is time consuming and not effective on all kinds of jobs. So one demerit of limitation of this personal observation is, yes, obviously it takes time. The supervisor, particular person need to be appointed to look after the subordinates, and that supervisor has to spend time on observing these people. Yes, then his time will be on observation only. It is time consuming and it is not effective on all kinds of jobs, right? So all kinds of jobs cannot be, that is, personally observed. Some planning work made by the planning, that is, committee, so where their work is thinking in mind, so it cannot be looked after by the supervisor what they are thinking. Yes, so such kind of jobs cannot be observed personally. So their work will be measured on the basis of how best they are giving the plans. Yes, not just seeing how they are sitting and how they are thinking. It cannot be observed, right? So otherwise, for common work, personal observation is effective. For some, only for few jobs, it is not effective, right? So personal observation is the most traditional method of or technique of controlling, right? So personally, the employees are checked, observed, supervised, right? This is how we can control the activities of the employees. Is it clear? Personal observation. The second one is statistical reports. Then what do you mean by statistical reports? Collecting all the datas. So whatever happens in the organization, so for all the things there will be records, there will be datas, and the management need to collect all these reports, all the datas, and these datas are analyzed later, studied. Okay, then how they will be studied? They will be studied in the form of averages, percentages, ratios, correlation, etc. What you are studying in the statistics. Okay, so statistics, how you are, that is, calculating averages, percentages, they are the end results. Before that, we have to collect the information. With the help of information, the datas, we are calculating percentages, averages, ratios, and correlations, standard deviations, so many things, index number, time series, all those things. So they will give us some ideas, some information about the performance of departments, the performance of individual persons. So like that, the things are verified. Okay, and these percentages, ratios, they will be presented So they will be presented in the form of charts, graphs and tables. Yes, they are the presentation. Information are the results what we are getting in percentages, ratios. They need to be put in the form of charts, graphs, tables. So by that we can easily understand the trends, growing trends, increasing trends, decreasing trends, fluctuating, what is happening, maybe in the sales, okay, in the expenses, in the incomes, that we are going to compare previous years, okay. Then we can also think for the future by making budget plans, and it helps to compare performance with previous periods and with the standards. Okay, and standards already we have fixed. That is the first function of management, planning. In the planning we have fixed the standards, benchmark for each and every work, and the results what we are getting in the form of percentages, ratios and all, they are the actual work, they are the actual performance, and this actual performance will be compared with the standards. Then we will come to know that whether the things are going according to a plan or there is some deviation, right? Yes, then the next one is, third one is break-even analysis. Yes, see here the picture is given, break-even analysis. Before that, we'll study the meaning, then we go for that. So, this is one more technique which is used to study the relationship between cost, value and profit. Value andre sales value. Okay, cost andre total expenses incurred for the production, sales including everything. Okay, total amount you have spent for the production, that is cost, and the total amount of sales what you have done, value, and what profit you have earned. So to make this study we are using break-even analysis. Okay, this technique will help us to study the relationship between cost, means we are going to compare for making this sales, what is the cost we incurred, total production cost and sales cost, everything. Then what profit we have earned. And break even is the point where it gives the point where there will be no profit or no sales. Okay, it helps to determine the probable profits and losses at different levels of activity. So what amount of sales if you do, how much profit you are going to earn. 100 units if you sell, for 100 units what is the profit. If the sales are less than 100, then how much loss you are going to incur. So minimum sales, 100 sales, where it is going to cover your cost. At least minimum 100 ಆದರೂ ಪ್ರಾಡಕ್ಟ್ ನೀವು ಸೇಲ್ ಮಾಡಬೇಕು ಅಂದ್ಕೊಳ್ರಿ. 100 ಈಸ್ ಅ ಬ್ರೇಕ್ ಇವನ್ ಪಾಯಿಂಟ್. ಸೊ ಈ 100 ಸೇಲ್ ಆಗಿರಲಿಲ್ಲ ಅಂತಂದರೆ ನಿಮಗೆ ಲಾಸ್ ಆಗ್ತದೆ. ಸೊ ಇಫ್ ಯು ಗೋ ಆನ್ ಸೆಲ್ಲಿಂಗ್ ಮೋರ್ ದೆನ್ 100 ಮೀನ್ಸ್ ಯು ಗೋ ಆನ್ ಅರ್ನಿಂಗ್ ಪ್ರಾಫಿಟ್. ಸೊ ದಿಸ್ 100 ನಂಬರ್ ಆಫ್ ಯೂನಿಟ್ಸ್ is called as a break even point, where it is not going to gain you anything, it is not going to give any profit to you, and it is not allow you to incur loss also. 100 means it is going to cover your total expenses but no profit. If you make effort and make more sales than 100 units, then definitely you start making the profit. So we are going to decide what is the point which is going to give us a break even, means no profit, no sales. So that we are going to study, and by the help of that the profit can be increased by making efforts to make the more sales. So the sales point where there is no profit or no loss is known as break even point. It is a sales point, means 100 units. This is the example. 100 unit ಅಂದರೆ ಈ 100 ಯೂನಿಟ್ ನೀವು ಸೇಲ್ ಮಾಡಿದರೆ, ಮಿನಿಮಮ್ 100 ಯೂನಿಟ್ ಸೇಲ್ ಮಾಡಿದರೆ ನಿಮಗೆ ಪ್ರಾಫಿಟು ಇಲ್ಲ, ಲಾಸು ಆಗೋದಿಲ್ಲ. ಅಂದರೆ ನೀವು ಏನು ಖರ್ಚು ಮಾಡಿರ್ತೀರಲ್ಲ ಆ ಖರ್ಚನ್ನ ಕವರ್ ಮಾಡ್ಕೊತೀರಿ. ಓಕೆ, that point itself is a break even point. And what you have to make? You have to make extra effort. You have to make extra effort to increase the sales more than 100. 100ಕ್ಕಿಂತ ಜಾಸ್ತಿ ಸೇಲ್ ಆದರೆ ನಿಮಗೆ ಪ್ರಾಫಿಟ್ ಸ್ಟಾರ್ಟ್ ಆಗ್ತದೆ. So like that, this we are going to take a point. that is break even point. And it helps manager in estimating profits at different levels of activity. So if we sell 120, then what will be our profit? If we sell more, that is 150 units, then what will be the profit? If we sell 200 units, what will be the profit? So it will help us to estimate profit at different points, at different levels of sales. Is it clear? It helps manager in estimating profits at different levels of activities. See, BEP is equal to the fixed cost. Fixed costs are those costs which are incurred even there is no production. They are fixed. For example, rent. Whether you that is use building or not, if you are taken on rent basis, you have to pay the rent, right? It is a fixed cost. So like that, there are so many costs are there. Whether you do the production or not, you have to incur the costs. So those costs are called as fixed cost. So we are going to take that fixed cost divided by selling per unit, sales price per unit. ಒಂದು ವಸ್ತುವಿನ ಮಾರಾಟದ ಬೆಲೆ minus variable cost per unit. So variable cost means this is a cost which varies, means which changes according to increase in the production. Means if there is production, then only this cost is incurred. For example, raw material. Raw material you are going to use only when there is a production. If there is no production, no raw material is used, right? So these some types of costs which are variable in nature, so which varies, which changes according to the production. Increase in the production, increase in the variable cost. Decrease in the production, decrease in the variable cost. So that cost per unit we are going to consider. Selling price per unit minus variable cost per unit. So these all you are going to study in the degree. You are going to calculate, right? And this BEP problems are solved when you study BCom. Clear? Here only just you remember theory part. Just the formula of BEP. BEP equal to fixed cost divided by selling price per unit minus variable cost per unit. See, and this is what the break even chart. See what is given. Cost and revenue vertical ಅಲ್ಲಿ ಏನು ಕೊಟ್ಟಿದ್ದಾರೆ, ಎಕ್ಸ್ ಆಕ್ಸಿಸ್ ಅಲ್ಲಿ ಕಾಸ್ಟ್ ಮತ್ತು ರೆವಿನ್ಯೂ ರುಪೀಸ್ ಇನ್ ಲ್ಯಾಕ್ಸ್. ವೈ ಆಕ್ಸಿಸ್ ಅಲ್ಲಿ ಏನು ಕೊಟ್ಟಿದ್ದಾರೆ, ಸಾರಿ ಎಕ್ಸ್ ಆಕ್ಸಿಸ್, ವೈ ಆಕ್ಸಿಸ್ ಅಲ್ಲಿ ಕಾಸ್ಟ್ ಮತ್ತು ರೆವಿನ್ಯೂ. ಎಕ್ಸ್ ಆಕ್ಸಿಸ್ ಅಲ್ಲಿ ಏನು ಕೊಟ್ಟಿದ್ದಾರೆ, ಸೇಲ್ಸ್ ವ್ಯಾಲ್ಯೂಮ್ ಇನ್ 1000 ಮೀನ್ಸ್ ಸೇಲ್ಸ್ ಮೇಡ್ in thousands. See, 50 units. If you make 50 units of sales, then it is a break-even point. So it is decided on the basis of total cost and total revenue. Two lines are there. See, ಇದನ್ನೇನು ನೀವು ಪ್ರಾಕ್ಟೀಸ್ ಮಾಡಬೇಕಾಗಿಲ್ಲ. Just for your reference I am showing this, right? ಜಸ್ಟ್ ಟೋಟಲ್ ಕಾಸ್ಟ್ ಮತ್ತು ಟೋಟಲ್ ರೆವೆನ್ಯೂ ಎಲ್ಲಿ ಮೀಟ್ ಆಗ್ತದೆ, ಎಲ್ಲಿ ಕ್ರಾಸ್ ಆಗ್ತದೆ, ಅದು ಪಾಯಿಂಟಿಗೆ ಏನಂತೀವಿ ನಾವು, ಬ್ರೇಕ್ ಇವನ್ ಪಾಯಿಂಟ್ ಅಂತೀವಿ. ಸೊ ಅಷ್ಟು ನೀವು ಸೇಲ್ಸ್ ಮಾಡಿದರೆ ಯು ಆರ್ ನಾಟ್ ಗೋಯಿಂಗ್ ಟು ಇನ್ಕರ್ ಎನಿ ಲಾಸ್ ಆರ್ ಯು ಆರ್ ನಾಟ್ ಗೋಯಿಂಗ್ ಟು ಅರ್ನ್ ಎನಿ ಪ್ರಾಫಿಟ್. ಇಫ್ ಯು ಇನ್ಕ್ರೀಸ್ ಮೋರ್ ದೆನ್ 50, then your profit starts. See, this line shows fixed cost, horizontal, perpendicular to the x-axis, means fixed in nature, it is not going to be changed. And variable cost varies, changes according to increase in the production. Okay, so this just remember here, it is not going to be asked any chart or any diagram in the exam, just one for your reference I have given here. And remember formula. What is break even analysis? Okay, it is a technique used by the managers to study the relationship between cost, value and profit. Right? And it determines the probable profits and losses at different levels of activity. Right? And this is the formula. BEP equal to fixed cost divided by selling price per unit minus variable cost per unit. So all these details you will come to know when you study degree. Right? Remember, this is third technique, traditional technique of managerial control. And the last one, fourth one, budgetary control. The fourth technique is budgetary control. So what do you mean by budget? Budget we are going to do for the future, Mungada Patra. Okay, planning for the next year on the basis of your total incomes and expenses. So budgetary control is a technique of managerial control in which all operations are planned in advance in the form of budgets, and the actual results are compared with the budgetary standards. So budgets means already fixed. The every activity production budget we have fixed what should be the production for a week, for a month. We have fixed what will be the sales for a week, for a month. This is our plan, it is our budget. Then we are going to see actually per week what is our production, per month what is our production. We are going to compare it. Per week what is our sales and what is our sales per month, and this we are comparing with the budgetary standards. Actual work is compared with the budgetary standards. Then we will come to know the deviation, the difference between budget and actual. So, and budget is a quantitative statement. So here we are going to define terms only in numbers. Generally budget will be done on the for incomes and expenses, quantitative, and it is done for a definite period of time, means maybe 1 month, 1 week, or 6 months, 1 year, like that. Okay, so that budget for 1 month, budget for 6 months, budget for 1 year. So for fixed period we are going to prepare budget in the form of incomes and expenses, and it contains figures of forecasts both in terms of time and quantity. Forecast means estimations. So that is the budget contains the future estimations, what will happen during what production we are going to make during this month, what sales we are going to make during this, means time means month or week, and quantity means what the total quantity of sales. So this month means time, this 1 month period, we are going to produce 2000 units. So 2000 units is the quantity. So it contains figures, the figures contains time as well as quantity. And the examples for the budgets are sales budget. We are going to prepare the sales budget for a week, for a month, for that is 6 months, for a year, like that. And similarly production budget, production of product A, B, C, whatever, how many products we are producing, for all that we are preparing budget. Right? Material budget, purchase of material, raw material. So we are making budget, what raw material is required for this much production. So budget need to be prepared. And cash budget, for all these activities, what amount of cash is required. So this production, that is purchase of material, for paying labor and all this. Cash budget, for the requirement of cash for the definite period of time. Similarly capital budget, so long term investment, long term investment in the form of fixed assets. Okay, so all capital budgets we have to prepare. We have to find out which investment is more profitable. On that basis we have to take the decision. And research and development budget for making improvement in our production. We go on making some research activities, right? So for that we need to prepare. We have to open research and development department, which will be headed by some scientists, okay, who are going to do the research for our company and give new ideas, new products to make sales for our customers, right? So these are the so many types of budgets what generally prepared. And the effectiveness of budgeting depends on how accurately estimates have been made about future. So it means that budgeting is not just simply sitting and telling some numbers. Yes, this much is the production you have to do this week. So we have to study the all possible things. What is our capacity? Okay, how much raw material is available, and what is our labor efficiency, and what are the machines, how many machines are available, the timing, everything we have to consider, analyze. Then estimations need to be decided. So it is applied for all types of budget. Budget is not just prepared with blind eyes. It is prepared with the help of your all possibilities, by considering all possibilities and all your strengths, weaknesses. By studying these budgets are fixed, and once these standards budgets are fixed, then it will help us to check our actual work. Then we can control if there is any deviation, if there is any difference, then management will come to control it. Is it clear? So how this budgetary control works in the organization as important techniques of managerial, traditional techniques of managerial control. And till today these techniques are in practice. As I already told you, traditional doesn't mean that they are outdated, they are obsoleted, they are practiced in some companies. Along with the modern techniques, these traditional techniques are also utilized, right? So understood these four techniques. What are the four techniques? Personal observation, statistical reports, break-even analysis, then budgetary control. Four techniques you have to remember, and try to remember minimum 2 to 3 points for each techniques. Clear? 4 marks it can be asked, and now 8 mark question may be asked by asking both traditional as well as modern. Anyhow you have to remember 4 here and 4 there, so which will help you to write even 8 marks question if it is asked according to new blueprint. Okay, is it clear? Hope you understood. And the traditional techniques of managerial control. And in the next class I will come with modern techniques of managerial control. They are 6 in numbers, so that we'll study in detail in the next class. Okay, till then take care and bye bye.